Hey, what's up, everybody? Welcome back. This is the fourth episode of the Micromath Capital Podcast. You got Small Cap Kev, myself, and Declan O'Flaherty, Mr. Fundamentals. Declan, how you doing, man?
Doing well. How about yourself?
Life is good. I mean, September, we're going into what's historically not a great month for the stock market. We've seen some of that already. Nvidia, probably the most loved stock on Wall Street, has taken a hit. We're going to talk about that as our first topic. We're going to talk about the government of Canada cut interest rates. That's big news up here in Canada. In the US, we can discuss that a little bit as well. Finally, we've got another small cap stock that we think is really interesting. It kind of blends bit of Alibaba, a bit of Amazon with a bit of their own unique flair, and they're trading at what looks like a really good valuation. So let's jump into that. One other thing that maybe I'll mention is our last episode that we filmed, we actually had our first guest, which was awesome. We got to interview the CEO of Tenaz Energy, a stock that seems to only go up. And that's a little tiny guy. We learned a lot from that. I mean, Declan, we had a really good conversation on that. How'd that leave you feeling? You're more excited about the stock now or less?
Yeah, well, it really showcases what Anthony Marino and his experience and just business prowess, it really speaks to all of that. And I think it was a great lesson for both investors and entrepreneurs on how to properly manage a business. So I was definitely feeling fortunate to kind of have that hour with him. And now we'll just continue to watch Tenaz grow and hopefully make some more exciting acquisitions in the future.
Yeah, I mean, it gives you comfort. If a company is looking to do acquisitions, generally we'd say we avoid those kind of stories. I think Tenaz is like a complete exception to that rule. Like you said with Anthony Marino, the guy, he structures fantastic deals. He's been doing it. He's made a career out of it. And he seems to continue doing it. When on the other side, we had a call with somebody who is unnamed, I will say for now, just for their own privacy, talking about Perion and kind of the opposite. So now there's a company that has an enormous amount of cash on the balance sheet. The stock only seems to go down in spite of what seems to be generally positive financial results. But then now they're talking about how they're not happy with management and they don't trust them with all that cash pile because they think they're going to waste it on a stupid acquisition. So it's funny seeing the opposite side. So, I mean, that was an interesting call, actually, Declan. That came through you. I mean, did that open your eyes a little bit and change your mind at all or anything
Yeah,
like
no,
that?
I think it was very interesting. And just bringing up points, I think there was similar sentiment shared through a lot of analyst research work that I had read on the business. I think the big thing here, and I was listening the other day to the investors podcast, and or I'm going to mess up his name, but anyways, this investor was basically explaining that to some extent you want to try and find opportunities where the market has kind of turned on the management, where they assess a decent management and they kind of scrutinize them and take it to the next level. And personally, I feel that is kind of what's happening here with Perion. Full disclosure, I do own it, shares in the business. So I obviously have bias, but I think in this instance, when I was doing my own digging into the business, I actually really admired how they had allocated their capital and even structured the acquisitions that they had made. So they kind of follow a philosophy of 1/3 in cash, and then the other 2/3 are only earned through incentives. And Charlie Munger was a big advocate of show me the incentives and I'll show you the outcome. And I think in this case, both of those acquisitions have proved to perform well. They met their performance objectives and they received the full cash compensation that they waited for. So it's one of those things. It's always good to have a balanced perspective. And I think having that negative sentiment is something that raises bells that you should pay attention to, regardless of whatever position you're at. But at the same time, I think it's probably blown out of proportion more than people are really expecting when they analyze this business.
That's interesting. I have not bought shares myself yet. Given how far it's fallen down, it's certainly getting more and more interesting, especially with such a large cash balance. And if there's any chance that there's any kind of board shakeup or people pushing them to do something other than acquisitions with their cash, things could get really interesting. So I'd say that call was eye-opening for me. And hey, we'll be continuing to follow along. But okay, I promised we'd start with Nvidia. So let's jump into that. It was a 10% drop, with which, if you're talking in penny stock or small cap land, 10% is nothing on a given day. We don't even think twice about a movement of that size. But if you're the biggest or one of the biggest companies in the entire world, then that's a gigantic move. Like this one day of trading wiped out 279 billion US dollars in market value, which is the biggest one-day market cap drop for a U.S. stock in history. I believe the runner-up to that award is Meta, back in, I want to say 2022. You were really hot on that one. Was that 2022 when they got just kicked?
Yeah, it was indeed. I think
Yeah.
about 230 billion. So this
Yeah.
trumps it
Okay.
by 40 billion.
So wow, and we saw how that thing did after that drop. So okay, Nvidia. This is obviously way larger than a typical company we cover. I just feel obligated to do this because it seems to be the one stock everyone wants to talk about. So my first kind of thoughts on Nvidia, without getting too deep into it, is this whole story is driven off AI. There's no surprise there. Beforehand, they were basically a gaming company, as far as I recall. I think they were gaming because they sold GPUs. Then it turns out GPUs were really good for crypto mining. And now, all of a sudden, seemingly out of nowhere ish, all of a sudden, they're a massive AI company. And just to show you how drastic of a move that is, I was looking through their financial statements. For the 6 months ended July 30th, 2023, so last year, their data center business did 14.6 billion. Huge number. But compare that to their gaming division, 4.7 billion. Okay, very respectable business. The 6 months ended this July, their data center business did almost $49 billion. So to show you how massive a jump that is, why do you think the stock has charged ahead this higher? But, I wonder, Declan, you're really dialed into these companies like Meta. There's a great example because that's a huge customer. One of their biggest customers, if not the biggest, I'm not exactly sure. Can they go on spending that money forever? What do you think? Like, is that a big risk to that stock that could, end this party?
Mhm. Well, I think that's the big story of 2024 for them is there's been a massive influx in the level of spending and investment. And I think right now, for example, Microsoft and Meta both are spending about 40% of their total capital expenditures on Nvidia products. So
Wow.
Nvidia is obviously winning here. Like that is a ridiculous amount of money, especially from these types of businesses. The big question now, both on my mind and I think is shared sentiment now throughout the market is, well, okay, all this investment has been made. Is this going to translate to real returns for investors in those other businesses? And will that lead to higher profit margins and just greater profitability overall? So when you look at a business like this, the big question is, can it continue on right now? And they've certainly benefited more than any company probably, and perhaps in all of history.
Mhm.
But you have to kind of anticipate that, okay, these big companies have made all these investments, are they going to continue that type of spending? Or now that they've built up their infrastructure and are starting to train these AI models, do they need to continue to make those kind of expenses? So I want to throw it back to you, though. It was interesting. This market sell off has kind of happened. And I was following Grit Capital there, and they kind of highlighted, well, if you thought NVIDIA was attractive at its previous price, you're going to like it more now. But when I want to ask you is, do you see this as a business that is now currently undervalued, or does it kind of remain in that fair value or even overvalued territory?
It's so tough with these kind of stocks because there's something that I've been told so many times is buy new highs. It's kind of the opposite of what we talk about where we try to, buy low, sell high. But the number of times I've been told by advisors to just buy new 52-week highs and ride them, just ride the momentum. And honestly, more often than not, it seems to be a half decent strategy. The one thing I'd say with Nvidia is, fair enough. If you loved it before and the stock drops 10%, it's true. You should love it more now. I would hope that people were trimming their position as the stock rallied over the last year, though I feel a lot of people probably weren't, unless you're the CEO, of course. That's different, and we'll talk about that. But, it's just good investing behavior to trim as the stock rises. You don't want any single stock to be too big of a piece of your portfolio. So I doubt people did that, but that's what I would have theoretically done. I don't own Nvidia, full disclosure. How I see it though is I don't see this AI train, going to the station and stopping now. Like I still think we have a couple years left. I'm pretty sure all of their major customers have said that they'll be buying this hardware as much as they can get into the foreseeable, a few years down the road. So I don't see any massive risk to this business. It's probably just going to keep getting better for the near term. But long term, you do wonder, like think about back when Meta was just punished by Wall Street when it was spending way too much money on, what is it called? Reality Labs. I think that's their metaverse division. Is that right? So they got punished by investors. Then they said, okay, hey, sorry, 2023 is the year, quote unquote, of efficiency. They slashed headcount, they reduced spending in certain things. And it's almost like now they're like, oh, well, hang on. AI, like, okay, let's get, and then Zuckerberg's right back at it. So it makes you wonder, is he just going to spend until eventually he gets spanked by the market and then has to be like, okay, fine, I'll reel it in. That's kind of where my head goes. I don't see this, uh, you know, massive capital expense going on to infinity. I don't think so anyways, but I just have so much more I need to learn, because if it was cryptocurrency mining, these, you know, machines within a year or two became expensive paperweights and you'd need the new technology. Are AI chips the same way? I don't exactly know. Maybe, but I also feel like the cost has to come down. Nvidia is just making too much money to not attract competitors to eat away at their margins. So this is a very long way of saying near term, I think the stock's probably fine. If you already own it, I probably wouldn't be looking to dump it unless you're way up, then trimming it is just good behavior. But I don't think this party goes on for more than a couple more years. God, I hope I don't quote myself on that and be completely wrong, but that's just how I feel. What do you think?
I think that's a really good analysis of the current conditions. There's still a lot of room in AI and just so much innovation coming about that you can't really put a cap on it. And there's a lot of these really like proven businesses that are making these investments. So it's not like how it was during the .com era where there's pets.com and all these different kind of no-name companies coming up with fake and manipulated balance sheets just to ride on the wave. So I think there is proven businesses that clearly see the value, and Nvidia itself is creating a lot of value. They clearly have the best product on the market today, and I believe it's their Blackwell chip, their next upcoming or next generation chip here, that is really proving to be quite phenomenal. So it'll be interesting to see how it translates. But again, it's just, has the market overvalued the current conditions? And again, say revenue starts to drop, say profits start to compress over the next year and a half, what does that do to a stock that is already currently at a $2.6 trillion market cap and was previously at a $3.1 trillion market cap, one of the biggest businesses in the world? So it's tough to believe that, like you said, they can just continue to do this forever.
Like, they're not going to grow at a screaming clip forever. They just can't. There's just not enough companies. Okay, here you go. Look at this. 46% of their revenue comes from 4 companies. Now, on their statements, it says company A, B, C, D, but we could probably do a little bit of math and think, okay, you know, Google, Meta, there's 2, right? So we could figure that out pretty quickly. And, you know, there's just no way the spending can go to infinity. And the thing is, when you're a growth stock, you get these massive multiples. Like, I don't know what the price to earnings is on this stock, but you get these massive, you know, valuation multiples. But that's only while you're growing like crazy. More you grow, higher multiple they give you. The moment that slows down, could even be positive growth, but just less than expected, and immediately your multiple can get smacked down. So I think this party is just going to be cruising until a speed bump probably derails it in a potentially significant way. That's how I'm seeing it. I don't see it coming in the near term, but I think within the next couple of years, we will see some kind of day of reckoning. That's just my guess. You know, for the sake of investors, I hope I'm wrong. I don't have skin in the game either way, but that's how I'd look. That's how I'd look to play this.
Yeah. Well, I think one thing that has kind of come to light to me over this period with Nvidia that I think perhaps is quite unpopular, but I'm going to kind of point some criticism towards the management. So Jensen Huang, he has obviously done an exceptional job, positioned the business in a way that they were able to capitalize on these key trends and make a lot of money. Now, what I've kind of seen over the past year is what I believe to be a degree of complacency, whether it's him or the board management in general, where they've made a lot of these small investments into various businesses. Even we were discussing one today called Applied Digital. They made just another position. I think they had one in SoundHound AI, Big Bear AI, various different small companies that have helped elevated those stocks and perhaps even helped elevated those businesses. They've secured much needed capital and it's from a big player. But if I was an investor analyzing a company like Nvidia, I'd be questioning, okay, why are you making all these kind of small, petty little investments in businesses that aren't really going to move the bottom line for you? The other part of it that we were briefly talking about there is they right now have a share buyback program for, I think they paid initially, like they bought back, was it $15.4 billion in the first half of 2020, fiscal 2025 this year. And they still have a remaining 7.5 billion on that current repurchase program. But they also, the board of directors just approved another $50 billion. Now, if you are one to do a discounted cash flow analysis or analyze the valuation of the business, and I think it would be fairly similar and shared idea across the board that most people think that Nvidia is fairly valued, perhaps even overvalued. Now, if that's the case, then when you buy back shares at an overvalued price, sure, it'll help elevate the price in the short run, but ultimately the business is going to return to its fundamental intrinsic value over time. And so that ends up harming the business and generating lower returns if those purchased shares start to decline. And so the additional irony to this is that Jensen himself has sold about 4.8 million shares for about $580 million. And then I was looking on Simply Wall Street, and this excluded Huang's investments, and they've sold $677 million in shares over the past 9 months. So that begs the question, why would management, the board, all these different people issue these share buyback programs and a pretty large portion of capital, like $50 billion is nothing to mess around with. And yet top insiders are selling their shares. It doesn't make sense. So I was curious like what you thought about that and if you shared that sentiment or if you kind of saw it in a different light.
I would say I could see it on both sides. Like, people often vilify CEOs for selling shares. I get why. It shows that you're not optimistic in the potential appreciation of share price of the next coming years. Obviously, that should make you nervous. Whereas if you see CEOs or insiders in general buying, you think, oh, they must know something. Like they must be optimistic. The company must be looking good. So obviously, as soon as you see an executive sell, that's bad. This is weird, obviously, because an insider is selling while the company itself is choosing to buy. So if one of them thinks it's undervalued, the other thinks it's overvalued. That's just a really weird, it's like poorly timed high five, you miss. So I don't really understand that. I would say, generally speaking, look, these guys have just done so well that for them to, anyone in the company, as far as I'm concerned, I wouldn't be surprised to see a lot of them selling. There's massive liquidity, massive share price increase, questions about whether or not this can go on forever. I think it's perfectly reasonable for people to buy. I don't really feel like buying the shares back from the company's point of view feels like the right move. At the very least, I feel like management and the company should be aligned in their decision on where they think the share price is going. Because it feels weird. What are the executives selling it to themselves via the company? Like, it's just a little goofy. So that doesn't totally sit right. Either one of those in isolation, I think, would be fine. But the company is, trading at a massive valuation. You'd probably prefer that they're using their cash to buy back shares to support the price if the price falls, or to buoy it. So I don't know. How are you feeling about it? Does it sit right with you that they're doing this?
Well, I think you nailed it, where if it's isolated, say management is selling off shares after this long successful run, makes total sense. It's a logical thing to do. Take your profits. You've worked hard and you've built up an excellent business. You deserve that. It's just contradicting where, as an investor, I want management to allocate capital in the most efficient and productive way possible. And if you're overspending for shares in a business that you probably understand the value better than anyone else. Now, the flip side of that is you could say, okay, maybe management believes the business still has room to grow. Maybe it could increase in value, but why would management be selling such a large portion of shares in that case? That's the one thing. Now, the other side of it is I think there's a common trend over the past few years where a lot of these major tech companies have built up these large cash accumulations, and it's causing them to be like, okay, well, we don't want to just invest in anything and burn this money or waste it by throwing mud on a wall and hoping it sticks. But at the same time, you also don't want them to they are trying to find ways to effectively allocate this capital, and share buyback seems to be one of the most common trends, which again, if the stock's undervalued, it is fantastic value for shareholders. But when you're overpaying for the stock, it can end up harming investors over the long run. And I think it's just more that managements are finding themselves in a tough position where they're like, we have all this cash. We don't have many things that we can invest in that can move the bottom line at this time. And so we need to do something, because otherwise shareholders are going to be like, well, why not pay it out in a dividend? And dividends are great, but they're also double taxed and very tax inefficient. And so they're trying to find these more efficient ways to use that capital. But at the same time, if it's not a smart way to use that money, then it's just kind of a waste. And I would rather them hold on to that cash as is.
That's more or less exactly how I feel. I'd say hang on to it. At some point, the stock's going to see some softness, and you want to see the company able to buy back shares. So that's my thought. I like dividends. I don't mind that. And of the 15.4 billion they returned to shareholders, it was a combination of dividends and share buybacks. So just another little context there. Okay, that's Nvidia. We could talk about this all day, but instead, there's some other news I want to get to. Bank of Canada cut rates again, which is amazing. Anybody who has a mortgage up here is breathing a sigh of relief. This market has been punished. Real estate has been really hurt, and it's very important for the Canadian economy. So they just cut interest rates another 25 basis points. That's 0.25%. We're now down to 4.25%, which one thing we can talk about is how that the divergence from the U.S. Interest rate. Their rates are much higher. That's going to attract capital to the U.S. economy. That's going to be positive for the U.S. currency, negative for the Canadian currency. Any negative for the Canadian currency would probably be a positive for our exports, but a negative to inflation because we import a lot of stuff. And anything we buy, now it's going to be more expensive. So there's two sides of the coin. This is the third consecutive cut. We have another meeting coming up in October. People, generally speaking, think it's going to be another 25 basis points. The question is, what's the U.S. going to do? You don't want Canadian interest rates to get too much lower to it, but I mean, generally speaking, when within the economy, Declan, like, how are you feeling about, like, what are you seeing? Inflation, interest rates, like, how are you feeling about everything?
Well, you covered the key point there. I think it really depends on what the US does and even China's economy, because I think these two global superpowers, they kind of lead the charge when it comes to the global economy at large. And so, although Canada has made these interest rate cuts, which usually investors associate that with an appreciation in prices as well as extra stimulation into the economy to kind of get the ball rolling, entice consumers to spend more of that money. The big thing here, though, is I think even though they are doing this, it's going to be kind of a lagging indicator. I don't really think it's going to incentivize consumers to really ramp up their purchases. Now, to be fair, I did see a stat there, and I don't have the exact number, but I did see a significant increase in the number of mortgage refinances now that mortgage rates have declined. So there's certain elements of it, but at the same time, at the end of the day, it always comes down to the US and, again, what China's economy is doing. Right now, China is in a recession and has been for some time. The US has kind of outlasted and survived thus far, and it's yet to be determined if the recession is coming. But I think for now, you're just going to kind of be in this limbo state where people aren't really trying to overspend until it's very clear that we're out of the recession and things are growing again. What about you?
Yeah, I mean, I feel like so much of just economics in general ignores human psychology, right? Interest rates come down, it definitely, anyone who refinances is probably going to see like a chunk in their added to their bank account every month. It's not that much. Like to give you context, I actually pulled out a good quote here. It was basically saying that a 25 basis point cut for an average person is going to be like $120 a month, right? They quote it as like a tank of diesel a month. I could get into the math, but that gives you a rough idea for an average person what that actually means. So 25 basis points helps. A percent starts making a decent difference. It could be your monthly groceries or something like that. Like it starts to add up. But I think after a lot of people were seemingly acted like they were taken by surprise when interest rates started going up so quick, and it really hurt a lot of people. Like they were seeing their mortgages. I have lots of friends that had their amount of money they paid every month to the bank doubled or came close to that. And that's like when your mortgage is thousands of dollars a month, that is a huge difference in your lifestyle, right? And I think you don't forget that kind of pain quickly, right? So the moment you have some more money in your bank account, I think a lot of people are just going to save that or roll it into, maybe they have other interest, maybe they have lines of credits they want to pay down or other debt that they might want to pay down. Maybe in some cases, this coincides with something that can allow them to put like a lump payment towards mortgage if there's no pre-penalty payment. Like maybe it's like that. But I think mostly people aren't going to just go out and spend that money. I think that's very few people are going to do that. We're already leveraged to the hilt. I think it's just going to go towards reducing debt wherever people can. Do you see a situation where maybe even a couple more interest rate cuts, does that start trickling back into the economy? Like, I wonder, what do you think? What point do you actually start to see consumers change their attitude. And this whole, they're calling it the vibe session. When does that end?
Yeah. Well, like you said, I think consumer sentiment psychology really ties into it here. And so long as the conditions remain uncertain and realistically, until things start to improve, the big thing here that I was going to outline too is that Canadian productivity has actually declined quite significantly, and especially relative to our peer countries. So I think within the past 5 years, it's fallen by 10% compare, or it's lagged 10% to the US. And then it's also lagging countries like Italy and Spain now. So long as Canadian productivity has kind of been in this poor performing state, it's not like it's going to translate to consumers being more confident about their own financial situations and pushing that forward. So until it true like we really come out of the clear, or it becomes very obvious that larger countries kind of face maybe these greater repercussions, say the US does go into a recession and it's very clear to everyone that, okay, yeah, the tough time in the economic cycle is right now, you're not going to see that translate whatsoever to increased productivity or increased spending from consumers within Canada, at least.
Mm-hmm. I mean, productivity is the key. Like, we need to focus on that. We're definitely not. Yeah, we've lagged the US for so long. I didn't know we were lagging like Italy. Wasn't there a time when they were calling those countries the pigs? Was it Portugal, Italy, Greece, and Spain, right?
Mm-hmm.
So now we're the ones lagging in productivity. That's interesting. I hadn't known that. But it makes sense. We have expensive unions. We generally don't invest too heavily in new technology. It's too bad, though. It seems like we invent a lot of it. Like, Canada is actually a pretty big hub for AI, for blockchain, for a lot nuclear fusion and fission. Like, we're a very science focused country, but it seems like the commercialization always happens in the US. I think a big part of that is you just get more productive workers and elsewhere. So it's too bad. But yeah, that's going to be a key thing for us to fix. I don't know what the solution is to that. Maybe it's an election. It sounds like we've got something coming up here. BC's actually got a provincial election coming up in a month. As you saw, the NDP and the Liberals kind of, they cut their pact. Doesn't sound like they're calling a new election, generally speaking, but we'll see when it comes to actually start voting on bills, what might change. But I mean, that could be interesting, because think about this. If the Conservatives get in, there goes the carbon tax. So that could be pretty significantly deflationary. Like, I can tell you, when I pay bills for some of our real estate properties, the carbon tax is a very big piece of that now. So that trickles into a lot of things like food and stuff. So I'd be curious how that could change. Does that change consumers' spending when now they're saving even more on that? Maybe taxes come down a little bit. That could be a whole other, no point even speculating on that quite yet. But I think there's more meaningful things that could happen than a 25 basis point rate cut. That's where I'm getting with this, basically.
Yeah, no, absolutely. And I think you highlighted a very important point that is really shaping out this year and the next year, is just the number of elections that are happening. No matter what comes of that, whatever parties are elected, there is going to be a huge shift in the overall direction of a lot of countries and their sentiment toward investing in new technology and infrastructure, but as well as various other policies. And so that always shapes conditions. I think the big thing as investors is try not to factor it too much. Like, it's certainly important to consider, and there's going to be policies that will affect different businesses, but do your best to just try and understand the core business itself. And usually that has fared quite well. You look at Warren Buffett, the number of presidents that he's kind of endured and experienced throughout his investing career, the guy continued to deliver results no matter if it was Democrat or Republican. So I think the same can be said for most investors, so long as you stick to the businesses that you own, or if you're an ETF investor, simply just continuing with your strategy that way so that you don't stray the course depending on who gets elected in the upcoming months.
True. Well, perfect segue. Speaking of focusing on individual businesses, let's do exactly that and talk about GigaCloud Technologies. So here's an interesting company, very respectable revenue. We'll get into the details. They're a B2B company. And actually, you know what, Declan, why don't you go ahead? Give us the about us for GigaCloud. What do these guys do?
Yeah, for sure. So this is a company that literally came across our table just this past week. So very new in terms of entering the watch list, but this is a business that provides and facilitates a B2B marketplace platform. And it basically connects manufacturers primarily in Asia with the rest of the world. And these are mostly resellers that they're working with, but they also focus on larger parcel deliveries. So that would be like furniture. It could also be various equipment and tools, but it's more on that larger niche side of things where they're serving that way. So they built up a really impressive kind of network. They have 42 strategically located fulfillment centers all across the world. They also have partnerships with shipping companies to reduce their rates as they transport these goods across the world. And as you'll see here, is that from a financial standpoint, it's translated quite in a very positive way for the business overall. And so it's one of those companies that I think a lot of people should start paying attention to. Add it to your radar, start to think about it and do some research, because it has the potential to really explode in the coming years, so long as it can really solidify itself in the marketplace.
I'm curious, I've got a lot of questions. So when I spent some time looking at this company, I see a few things. It's like got some Amazon FBA elements. There's some like logistical platform elements, physical warehousing, which is Amazon FBA, I guess. Then some kind of Alibaba, which is like got the Asian angle, wholesalers, like you're buying, like on Alibaba, you can literally buy steel, which is interesting. You can buy steel and ship it somewhere, which is wild. So large object, like a furniture furniture or mattress. That's a great example. Something more realistic that you'd probably be buying than a bunch of steel. But hey, you never know. Depends what business you're in. But what I'm trying to understand is, I guess I'm trying to wrap my head around the competitive advantage, which, I mean, they've clearly got something, because revenue in 2021 was 414 million. That's already really respectable. In 2023, 703 million. So clearly there is a reason, like Alibaba has an FBA fulfilled by Alibaba service option, I'll call it. So there is clearly some reason to be working with these guys as well. I look forward to exploring what that is, but you're seeing it in the numbers, no debt, $200 million in cash, probably more than that by now. Revenue is growing very well. They're obviously profitable. So everything seems to be looking good. One thing I do wonder is that obviously there was that massive bottleneck, that supply chain nightmare of COVID era, and everybody shipping products. So I would imagine that's probably part of their success as to why even furniture is like literally a perfect example of something that was massively out of stock, all kinds of logistical issues. You would probably really need a company like this to help with something like that. I'm curious what it looks like going forward. I think understanding their competitive advantage is like probably my number one thing I want to really wrap my head around. Actually, maybe I pass it back to you. Is that something you're starting to understand, or do you also have to keep digging into that specific aspect of this?
Yeah, well, I think the target market that they're really focusing on is these resellers and trying to build a platform for businesses. Like you said, this is very similar to Alibaba in a way, where I think their focus has kind of shifted from what Alibaba is doing. Is Alibaba remains a very much Chinese centric company. They do obviously do a lot of business internationally, but that concentration of Chinese business still remains a very high portion of their revenue today. On the other hand, this company seems like it's very internationally focused and trying to connect people with, perhaps again, those cheaper goods and products that come from various Asian countries, and the cheaper labor costs that obviously translates further down that road. What they're doing is providing them with an outlet that they can effectively and consistently deliver those products. Now, like you said, they've got to compete against some giants, whether it's Alibaba, even Temu or Pinduoduo, or even Amazon itself. These different companies, they're in a market with some really big titans. So whether that they truly have a competitive advantage is unclear. I think the big thing right now that you're seeing is, more than anything, maybe it's just that this logistics and e-commerce market is just so massive. There's a lot of room for smaller players to kind of take a chunk out of these various businesses. And in this case, them focusing on things like furniture, maybe if they master that, then they can progress and easily translate to other large parcels without really disrupting or being challenged by bigger players such as Alibaba.
Yeah. And I mean, I guess at the end of the day, they are specifically niching in on large parcels. Like Alibaba, you could buy everything from like a Halloween mask to, like I said, steel or couches. So clearly there is, domain expertise is important. I'm sure there's some specific logistical challenges around large, heavy items. So I can see how they could carve that out. But you know what? You might be very well right. its e-commerce is huge. It's growing. It just got so much bigger over the last few years that, yeah, maybe there just is room for many players. We'll have to see. I'm curious. I mean, they have this really good all-in-one solution, which I find very interesting. Combining software with physical warehouses with this platform that connects buyers and sellers. So it does seem to be a pretty integrated ecosystem, I suppose, they've built. I would say, what's interesting is like the valuation, market cap of just over 800 million, 2023 revenue somewhere around 700 million. So cheap from a price to sales perspective. They've got, they're profitable as well. So we like that. And they've recently announced their $46 million share repurchase agreement. So, okay, great example. Let's compare them to Nvidia, where one is buying at the top of the market, one is buying not at the bottom of the market, but when you don't really have to stretch your brain to figure out that this is like, from a fundamental perspective, it looks quite cheap. So management is supporting when the share price is at a lower level. That's generally accepted as something that, as long as the company's not going out of business, like they are showing their support and their optimism for the future. So it's kind of the opposite of how I'm seeing it with Nvidia, which is interesting. So, I mean, I like that. Beyond that, I don't have, well, I'm gonna have to go a lot deeper with this company. I don't know if you have any views on either the share repurchase program or if you just want to freestyle, if there's anything else you want to dig into with these guys.
Yeah, well, I think the big question, and you've brought it up a couple times, is perhaps why is the stock where it is trading today? Why is it a higher valuation, or how is it going to succeed in this marketplace? And so part of the research leading up to this, I was trying to look at these different analyst reports to see, what are the key points that they're saying, okay, this is the reasons not to buy this business. And the big push right now is that, to your point, perhaps about the following the COVID surge, there is that business is going to slow down and start to normalize, and this will kind of compress growth moving forward. The other part of it is that they were discussing how earnings growth hasn't matched the growth of revenue itself. So over the trailing 12 months on a year over year basis, revenue grew 96.5%. And I think earnings grew about I think it was 74% or so. So it's lagging to some extent. And they're saying that they're struggling to kind of scale at the same time or maintain their business model as their revenue grows. And so that is going to lead to greater friction moving forward as well. The big thing here, though, that kind of, when I scratch my head and I get that argument, like, okay, yeah, it's lagging, but at the same time, the business is growing revenue at 96% year over year. Yeah. Like, that's a ridiculous number. Like,
it is.
Either way, if you can buy this business at an attractive price and there is room to grow and for them to capitalize. And just one other point to that is management seems very thorough and they understand their market well. Their CEO is their founder, and he was even awarded, I think, LA's best entrepreneur this past year. Wow. So just little testaments to their management and who's running the show there, that I think they are doing a very good job thus far. And it's not like you have somebody at the helm that's just kind of blindly benefiting from a market that they got lucky on. They clearly know what they're doing. They know what the solution and the offering that they're creating. And perhaps this creates an opportunity for them to build a really strong network effect between producers and consumers moving forward.
Yeah. And for context, if somebody's not familiar with the share price, I mean, look back at January, was it March 15? March 15, they peaked at they closed at $43.15 a share. Stock price right now is closer to $18. So to give you, some perspective on where the share price has come, it's come way down. So not the first time we've tried to catch a falling blade, and it's so hard to know when to buy into a company that's, you could say, being repriced, essentially, if the business has changed or whatever. And it looks like something is changing here, of course. But I mean, just that magnitude of a fall in price is very hard to ignore, especially when, just like you said, fundamentally, let's just talk about revenue. The growth is there. It's significant. It's like a very, very high rate of growth. So fine, maybe not all of it's translating into earnings, but it starts with revenue. It all starts with revenue. Without that, no earnings don't exist regardless.
Yeah, no, exactly. And perhaps just one final twist on why maybe the business or the stock itself hasn't performed is, obviously, over recent years, investor sentiment towards Chinese businesses has kind of declined. And so long as that kind of is the case, it may be tough for people who typically would invest internationally and perhaps in a business of this quality now may be a little hesitant just with the current uncertainties that exist and the conflicts that are arising and the competitiveness between the US and China. So until those things become more clear, it's probably going to sit back, just as many Chinese companies like Alibaba, Tencent, Pinduoduo have suffered in recent periods. So that's just one more thing to consider.
And interesting, I'm just looking at a chart on Yahoo Finance, and the one final thing I'll say is I'm looking at the chart and then the earnings dates. Overlaid with the earnings dates and the actual positive or negative surprise factor. If you look at, so they're March 15, where the stock dropped substantially after that, the estimate was 58 cents a share and they delivered 94 cents. That's a 62.07% positive surprise. Share price went down. Then go forward one more time, go to May 9th. Earnings per share, the estimate was 63 cents. They delivered 84 cents, a 33.33% positive surprise. Stock went down. Go one more, August 6th. Market was expecting 71 cents. They delivered $1.03, 45.07% positive surprise. Stock went down. So when we start seeing things like this, we start getting really interested. But we got to understand, just like with those other activists that we spoke with on another file, another investment, are we missing something here? Is there some other underlying story or something we don't understand? Because the math ain't mathin' on this one. And I am wildly curious to keep learning.
No, same here. The logic doesn't make sense in that regard, but I think that's one of those things you can't really fully understand a business in a week of research. So we'll dive further into this and hopefully provide some more insights that really kind of get down to the bottom of this so that we do have a full comprehensive understanding of the business and what the investment prospects are.
That's right. Well, welcome to the watch list, GigaCloud Technology. That's GCT if you guys are looking for the ticker. And you know what? Let's conclude it there because that's an action-packed episode 4 from the market. Wow, I almost said our name wrong. From the Micro Map Capital podcast. This is Small Cap Kev, and you have Mr. Fundamentals as well. Thank you guys for tuning in, and we'll see you again in a couple weeks.